Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the markets, we'll take a look at oil and the amazing developments that have happened over the course of this week, and then look at the U.S. dollar, gold, and silver, and see how they're doing and see if anything is affecting the markets. After that, we'll move on to chart requests. If anyone here has a chart request, you can always add it in chat, and I'll get to it as soon as we go ahead and cover the markets and commodities. If you like what you see here, you want to be kept up to date as far as when I'm going to stream or when I post stuff, you can always follow me at Stock Darts on Twitter. You can see the copies of this on YouTube at Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list stuff, and just in general go over and expand on some of the trading ideas that we cover on these Wednesday market reviews. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. And as you can see, we're doing decent. Today we're up. I'm expecting us to pull back, and we did pull back over the last couple of days, but we found buyers, and that's actually a good sign. Although I think that we're still a little overpriced for where we stand as far as our economy is concerned. The good thing is that we're finding a bid pretty constantly in this market, which is showing that the overall selling pressure that we had in March is at this point really not a factor. And every time we drop now, you have buyers that are stepping in because they have confidence that the market's not going to continue crashing lower, and that we're right around the corner right about to turn the corner on this whole coronavirus situation and start come back and resuming our normal lives. Now, I think that's a little optimistic. I think that we're still going to be stuck self-isolating, and even when we do open up businesses again and start to be able to come back and work, there's going to still be a lot of consumers that are going to be scared to travel, to really go out and shop. We're still going to have restrictions in place as far as large gatherings. So I don't think that we're just going to all of a sudden open our doors in April, or at the end of April, really, because we're already there, and things are going to go back to normal. So in my mind, we're getting a little ahead of ourselves in the market. Now, that being said, one of the first things you learn as a trader is you don't argue with the markets. You just basically follow along. And so I'm not going to sit here and argue with the markets and say that they don't deserve to be where they are. We've had a lot of stimulus come in, and that has certainly helped push the markets up. But a lot of it is just the optimism of investors thinking that we're ready to move forward. And if we keep trading higher, I'm not going to go ahead and argue and say we shouldn't be up there. But that being said, I'm not happy with the risk reward that we have at the moment in these areas, and I always reserve the right to not buy if I don't like the price. And at the moment, I don't really like the price to go long too much, and so I'm really looking more for short trades if we continue to roll over in the markets. Now, as we can see in the S&P 500, we found a very good level of support here around 273, 274, and at the moment that's holding up. We saw yesterday we tried to push back through it, and that would have been the nice turning point where we would have gotten to move back down, probably a much sharper move back to the 20-period moving average around 267, and then maybe even overshoot it and start to come back into the low 260s. But that didn't happen. We found buyers that stepped in and supported price, and as you can see today, we're trying to come right back up and retest that area. Now, this often happens. We discussed this last week when we were looking at rising wedges and what happens when you break down from them. What often happens is you get the quick breakdown, and then you come right back up and you retest that breakout point, or that breakdown point, which in this case is right around 281 to 280. That's going to also be a retest of the 50-period moving average, which, as you can see, price action was strongly rebuffed as we tried to get through the 50-period moving average. Again, a common occurrence that often happens when you are shifting trends, where you first get stuck at the 20-period and eventually break through it. Then you come up to the 50, and then you'll get stuck there and come back and then chop back and forth between the 20 and the 50 until you have enough strength to either push through, or you end up resolving back towards the other direction and heading back and testing prior levels. And that's really where we are right now with the markets in general. We've found what is a pretty sustainable bottom, and we are now in the process of trading sideways. and just exploring price, trying to figure out exactly where resistance lies and where support lies. And right now we're kind of in the middle, really, because I think resistance is going to be somewhere really closer to about 290 than the 285 that we just saw. And support is going to be down here around 255, 256, which is quite a bit of ways from where we are. So that gives us plenty of room to the upside and to the downside, which makes it kind of a trickier environment to trade, because you have a lot of room to the downside if you wanted to go long, and you have a lot of room to the upside if you wanted to go short. Which is one of the reasons that these types of weeks I like to focus more on earnings trades. We're in the middle of an earnings season. We had Netflix report yesterday, Chipotle report, and a few others. And often during a market, when I'm a little bit uncertain as to what it's doing, I just shift focus if we have an earnings season, and just take advantage of that. And that's what I did yesterday with Netflix. And so far that trade's working out pretty well for me. I will cover that, I guess, when we go over towards the chart request. But for now, if you are trying to trade this, there's one thing I want to point out. We're not in an easy market. This is not an easy market. So if you feel like you are looking for trades and struggling, you don't have to force the action here. There are times when the market is easy to trade. So if we come back and we just hit the reverse button here and we take a look at where we were the last couple of years. When you have a market climbing upwards like we did towards the end of last year, beginning of this year, that is an easy market. That's a market that erases a lot of mistakes. That's a market that for the most part that the prevailing direction. And you just have to jump on the train and let it take you to the next stop, right? What is not an easy market is when you have something like this, where we're starting to drop, we're starting to correct, and we're now at a point where we don't know if we've corrected enough, if we've overcorrected, or what the next step is. And when we get to these situations, these are the tougher markets, and these are the ones where you need to be more cautious of how you are trading and make sure that you are limiting risk. And if you don't like the trades that are available, you just don't take them. And you wait for better opportunities. And there's really nothing wrong with that. As always, there's always going to be a better market coming at some point. And when that happens, you can go back to trading regularly. Now, some of us, like myself and maybe some of the viewers here, are trading for a living or attempting to trade for a living. And if that's the case, then you have to kind of manufacture profits. And that's why I have different types of trades I like to take. And that's why I always try to encourage different instruments and different markets for you guys when we go ahead and do these Wednesday market reviews. That's why we look at the Forex, we look at the US dollar crosses. That's why we look at oil, gold, silver. That's why we look at options trades, because you want to have a bunch of tools in your toolbox so that you can take advantage of whatever market environment is giving you. And I think at the moment, I'm more excited about taking earnings trades than I am about trying to figure out the next direction. Now, that being said, like I said, I'm more interested in short trades. My focus this week as we started was on looking for names to short if the market started to roll over. And the market started to roll over. And my shorts are right on the cusp of triggering, but they haven't triggered yet. But that's something that I'm waiting for. And if they trigger, then go out, cool, I'll go ahead and take a short. If they don't, no big deal. I'll wait to see what happens next week and move from there. If we have a decent amount of consolidation here, so let's say over the course of the next 3, 4, 5 days, right, we continue to trade along this trajectory, right? We bounce off of this 273 area, and we continue to struggle against the 50, and price action gets tighter and tighter, right? And then we break out. Well, then that's a good long trade, and at that point I might be a little bit more willing to take a long trade, because at that point we have a risk-reward scenario that's okay. We understand that we stop out if we fall below 273, and we can look for a move back towards 287 and possibly all the way up to the 200-pair moving average, or even just this 293, 294 area. So in that scenario, we would have had enough chance and enough time for the structure of the market to change enough for us to go ahead and take a long play. But until I see something like that, then I'm going to wait, and I'm going to more likely than not anticipate a rollover and a move back to the 20-pair moving average, at which point maybe some of the shorts that I'm looking at trigger. And that's kind of how you have to go ahead and follow the market sometimes. We've gone over this before on these Wednesday market streams where, a lot of retail traders and a lot of people that don't really trade assume that traders are guessing on price action, and that's how you make your money, is by predicting where the market's going, and that's not really the case. Of course, you kind of have to come up with scenarios and sort of predict where you think it's going to go, but in reality what you're doing is reacting to what price does and what price gives you. And so what you're doing is you're waiting for a scenario that you outlined or a hypothesis to come to fruition, and then from there you go ahead and you try to take that play. And at the moment, that's what I'm waiting for. I think we did trigger a short opportunity on the S&P 500, and I think until we break back above 283, I would suspect that we are still pulling back, and not necessarily going forward. But at the same time, there's another interpretation of the price action, like I said, which is that we're still chopping back and forth, and we're building a bull flag in this area. So at the moment, there's really potential for two different ways. Now, let's take a look at all of the major levels of support and resistance here, so we have an outline of where the S&P 500 could go, depending on whether it wants to keep pushing forward or backwards. Now, we've already outlined the very short-term support level here at 274. If we lose that, I think the 20-pair moving average would just be a short pit stop, and more likely than not, we'd overshoot it and come down here to this 261, 255. I don't expect us to lose that at this time. With the amount of buyers that are still stepping in and supporting the price action, we probably don't lose that level on any pullback that we have, unless really bad news comes in. Now, to the upside, we've already discussed it. 295 and the 200-pair moving average around 300 are basically the ceiling of price action. I don't expect us to push past that. I think if we do push past that, that to me is a pretty good opportunity to go ahead and try to short once I see a reversal pattern and once I see that the sellers are stepping in and stopping price action, or we get too much supply to push through. Other than that, that's really the S&P 500 in a nutshell. I think the key to really point out right now is that we're neutral. We're no longer just in a straight downward action, and the short-term rise, I think, is reaching kind of its culminating point, and I think at this point we've kind of downshifted back to sideways, and we probably will be trading sideways over at least until next week, and we start to see more of the major, like Amazon, Google, Facebook. Once we start to see their earnings reports, Apple, I think we might have a clear understanding of where the market wants to go and what kind of impact we've seen over the last quarter, with companies really not doing any business, or very limited amounts of business. Now, we take a look, interestingly enough, at the NASDAQ, you'll see, relatively speaking, a much stronger index, right? We are, not that far away from all-time highs, and pretty well above, and we'll go to the weekly chart for this, pretty well above most of the action that we've traded in over the last couple of years. You can see where we are right now. We came back and traded in that area for a little bit, and we've made our way all the way back up to this 211, 212 area, very much ahead of or above this 187 resistance. Now, contrast that to what we just saw in the S&P 500. If you go ahead and take a look at a weekly chart of the S&P 500 and you see where we are, we're for the most part still stuck in a range and still trading along most of the same price action that we've seen since 2018. Right? For the most part, we've traded in a range between about 295 and about 255, and we're kind of right smack in the middle of that, around the 280s, and really struggling to get ourselves back above that ceiling. And I don't know that we're really ready to do that at this point. However, there's a stark contrast between the S&P 500 and the NASDAQ. As you can see, tech names are keeping the market afloat right now, and they're the ones that are really starting to outperform and do better. And those of you that follow me on Patreon and go ahead and have access to some of my trade ideas, you'll know that we shifted in March quite strongly to start focusing on tech names, particularly tech names that benefit from either work at home or shopping at home, stuff like Amazon, Zoom, Citrix, and they've done extremely well. They're up well over 50% since on average, not just one of them, from when we looked at them. And I think that trend is going to still continue until we really shift back to, to tell you the truth, this was a trend that was already starting even before we had to start quarantining and social distancing, and I think it's something that's going to continue to impact our society. So generally speaking, those names are going to continue to outperform, and really the only issue will be at some point there will be a blowback because they've performed strongly during this environment, and once we open the doors, then there's going to be some profit taking on them, and money rushing into others as people assume that they will start to lose business once we move back to normal. And that's kind of one of the issues that's affecting Netflix at the moment. So we go ahead and take a look at Netflix. You'll see Netflix. And this white rectangle was what the options were pricing in as far as the move is concerned. And my play over on earnings was that it was going to stay inside of that, which it did clearly, almost unchanged. But one of the issues with Netflix was Netflix had blowout earnings, and they didn't really move because the market was expecting that already. And one of the things they're concerned about is once we open up our doors and start going back to work, are all these new subscribers going to leave? So as you can see, the market is usually looking forward in these types of scenarios, and that's really the only issue with some of these stocks like Amazon or Netflix. At the moment, they're all performing very well, and the only reason they'll pull back is because people think at some point they'll lose some of the business that they've gained during this time. But in my mind, even though they will lose some of it, they're going to continue to grow because these were strong companies that were still getting a bigger share of the marketplace even before this whole pandemic. And while they might have a temporary setback once a few people that had to use it don't need to use it anymore, these are still businesses that are growing and are going to continue to need more and more of these services as we continue to move forward. So generally speaking, I think that this is where you want to be if you are trying to be long this market. Is you want to look at tech, you want to look at particularly tech names that benefit from people working at home, or just generally speaking, did not lose business from malls closing, restaurants closing, travel closing, stuff like that. Right, and so as you can see, it's pretty clear. The Nasdaq is holding up very well. A lot of its components are doing strongly now. Of course, not everything is, but enough to prop it up and keep it higher. Now, I do think that we are again reaching levels that I don't think are really sustainable in the short term. Because we're not really in the same place economically speaking as where we were in February and January. And that's really right where we're at. We're already reaching the points where we traded to start this year, which was a market that was already getting a little ahead of itself. So I consider this to be an area of pretty strong resistance, particularly here around 217 and above. And I don't expect us to really push past that in the short term. And if we do, again, I'm going to see that as a shorting opportunity because I don't think we're ready for all-time highs. And I don't like the risk-reward of trying to go long here. I'd much rather be on the other side of that once I see a rollover. And again, we've had a series of rising wedges. Again, this was a pattern we discussed last week. And you can see we've got a little series of them building up on the NASDAQ. In a lot of ways, a shorter-term reflection of exactly what we saw to start this year. We had a rising channel, and then we had a rising wedge, and then another rising wedge, and that eventually led to the imbalance in buyers and sellers, and of course what happened once we started to close down businesses. And as we're making our way back up, we're starting to see a lot of the same sort of price action, just on a smaller time frame. We've got a little bit of a rising move, then we've got a rising wedge, then we've got another rising wedge, and we finally had a breakdown from it. And I think that's, again, the first sign of what should be a short-term correction for us now, as we've gotten a pretty strong recovery off of our bottom here in March. And I think at this point we need to come back and retrace and test some prior levels of support. And you can see we had a big drop on the NASDAQ yesterday, came back and tested the 50. Now, again, in contrast to the S&P 500, we're actually above all the moving averages. We're above the 50, the 200, the 20. So the NASDAQ is actually attempting to already shift the trend back upwards. I don't know how long that holds. I think we're going to come back and test all three of these moving averages again, and we should find some decent support here right around the 200 as the three moving averages all come together and converge and cross, which also is, horizontally speaking, a decent support level up here around this area that we use as a launching pad at the end of the year to take off and rally into the holidays and beyond. And that should be a strong level of support on the Qs. And if we do fall below that, I don't expect anything lower than 193. I think 193 is a very, very strong area of support. And if you're long tech, then that's the area you want to look at, and this area around 200. Now, again, I also offered this idea for those of you that were hesitant to trade individual names. If you just want to trade ETFs, then you should just look at whenever you're bullish, go long the Qs, and whenever you're bearish, we'll get into a second, but you just short IWM. And if that's the case, then what you're looking for is support here at 201, and worst case scenario, support around 193. If we lose 193, then all bets are off, and that means that we've had a lot more bad news come in than we expected. And at that point, then we need to really shift back towards a bearish mentality and start looking at lower price action. But I think for the moment, like I said, I think the market more than anything has graduated to neutral, and at that point we should just be looking for a range to develop and try to figure out where the top of that range is and where the bottom of that range is. And I think at the moment we've discovered what is probably going to be the top of our short-term range, and now we need to come back and figure out what the bottom of that short-term range is. Now it could happen right away, or it could be that we need to come up and retest that top again before we head back lower. But generally speaking, I think that's the type of environment we're in. And I think if anything, we'll see exactly how that plays out as we move forward with earnings and see some of the bigger tech names report. And I think they're going to be, like I said, some of the key ones. If we take a look again, so like Amazon, Amazon reports next in 8 days, right? So at the end of the month, we've got Apple, which also reports on the same day. Google, which reports very soon, in 5 days, and then Facebook, which also reports in 7 days, right? So basically, next week, on Wednesday and Thursday, is going to be a critical day. Facebook and then the other two on Thursday. And that's going to be a good idea, or it's going to give us a good barometer on what exactly we can expect out of the market in general and what we can see out of the NASDAQ. But until then, again, I think that we're just exploring price action in both directions, and more than anything, trying to figure out where the market wants to go next and what the market suspects is going to happen. And that's kind of what we have with the Qs. Now, if we look at the Dow Jones, we'll see, relatively speaking, a weaker picture. And again, this is a transition. The Dow Jones, of course, is an industrial average, and so a lot of, or several of the businesses in the Dow have been hit pretty hard with this economic slowdown. And as a result, the Dow Jones Index has struggled to keep up with the NASDAQ and even with the S&P 500. As you can see, we're actually below, and this white line, which was supporting the other two indices, is this March 11th to March 12th turn, which was a really critical point in the Corona pandemic. This was when the NBA decided to close or postpone their season, and all the other sports leagues and a lot of businesses followed suit and basically did the same thing. And that's when the market really accelerated to the downside. And we've come back and eclipsed that price on the S&P 500 and the NASDAQ. As you can see, the Dow Jones is really struggling with that price area. We've got, again, a rising channel slash wedge. In this case, it's a channel, not a wedge. But we had the breakdown yesterday well below this 233 area, but we've come right back up above it today. So we're trying desperately to hold above this. Again, like the S&P 500, we're in between the 50 and the 20-pair moving average. But if we look at the weekly, you can see we're still kind of holding below most of the price action we've had the last couple of years. Again, showing relative weakness in the Dow. And more than anything, really, a lot of what we just mentioned with the S&P 500 also stands with the Dow Jones, which is basically we had a nice bottom. We've made our way upwards, but at this point, we're just trading sideways. We're trying to explore exactly where the top and bottom of our range is. As you can see, the Dow Jones is really struggling to get back into that previous range. We got, again, rebuffed at the 50-pair moving average, and are really just trying to shift the trend from straight down back to at least sideways and then possibly back up. And as I said before, this often happens where you'll break the 20, you'll come up to the 50, then you'll kind of chop back and forth between the two, and then it's the next move that really decides whether you finally bottomed or whether you need to come back and retest. So it's going to be a matter of whether we can break through the 50 or the 20 that's going to decide the ultimate direction for the Dow Jones in the near future. And I think at this point it's up for debate. I'd be lying to you if I said I knew which way it's going to go. I think it's going to just depend on what happens with earnings over the next couple of weeks, and more than anything, whether we're really finally ready to open up some businesses, and if so, how we go ahead and proceed to go back and try to get back to normal. And like I said, I personally don't think that we're really ready to get back to normal for a while. so I don't expect a lot more upside. With the Dow Jones, there's plenty of room here for it to try to recover and before it hits real critical levels of resistance. But generally speaking, if I'm looking for resistance levels, I'm going to see where where the S&P 500, the Nasdaq hit, more than the Dow Jones. I think the Dow Jones will just kind of lag behind the other two. So if the Nasdaq and the S&P 500 rally up to their resistance levels, then I think the Dow Jones will slowly climb upwards and make its way towards this gap here, but it won't make it all the way back up to the 200, at least not initially, unless the other two outperform strongly. Now, as far as support, if we fall lower, I think the key here is that we don't lose. Well, obviously we don't want to lose 235 or 233, but if we lose that, we don't want to lose this area right around 213, 214. If we lose that, then it means that we're probably going to have to come back and test all the way down to the lows, which I think most people are hoping we're done with, and that we found a good bottom, and we're just really chopping back and forth as we wait for better news in order to start making our way back upwards and towards the top of that range that we spent the last couple of years in. And so it's kind of where we stand in the Dow Jones. I think more than anything, like I said, just trading sideways and trying to figure out where we want to go next. Now, of course, the one real different index is IWM. By the way, for those that just came in or have kind of been streaming in as we started, typically after we cover these market ETFs, we'll take a quick look at the U.S. dollar and gold, silver, and oil, and then we'll move on to chart requests. So if you have a chart that you want me to look at, you want me to analyze, feel free to type it into the chat, and I will go ahead and spend some time going over those charts and seeing what we can come up with. And it doesn't have to be a trade idea. It could be even if you just have a question on a pattern. Now, looking at IWM, obviously, relatively speaking, much weaker than the other three. If we take a look at a weekly chart, you see where we stand compared to where we traded over the last few years. We're all the way back down to what we traded in 2016, 2015, way below 2018 and 2019, showing again that traders have one foot out the door in this market. Now, we'll often go over this relationship when we do these Wednesday streams, which is that IWM is a representation of risk. It's the more volatile assets, they're the smaller and more risky assets, and typically you want them to perform well during bull markets because that shows that traders are taking risks. At this point, clearly traders are avoiding risk as much as possible, and that's a clear representation of why IWM is down so much, is because traders refuse to hold names that they think can give them adverse risk, particularly in a situation like this where overnight news could really turn around a market, especially over the weekends. So for the most part, traders are just very hesitant to assume risk, and that means they're going to avoid IWM, and they're going to avoid a lot of the small caps that are components of IWM. And so, as you can see, we're way below the 50. We haven't even come close to the 50. We're way below the 200. We actually haven't broken through that March 11th turning point in the market and are still kind of struggling. Now, that being said, in the short term, they've held up all right. We've got a little bull flag here. I'll go ahead and reappropriate this trend line. I don't think it's necessary to show that trend anymore. And so you can see that we are kind of consolidating, still trying to find support here at the 20-pair moving average and make our way up to the 50. So generally speaking, IWM is lagging behind the other three indices. The other three indices broke the 20, pulled back a little bit, and then went up and tested the 50. IWM is still just kind of trading sideways, waiting to test the 50, waiting to get back above 124. I mentioned a minute ago that if you're looking for resistance and where the market is going, you can look at the S&P 500, the NASDAQ. If you're looking for support and you're trying to figure out the quickest signal that the market is selling off, then this is where you want to look. If we have a more substantial rollover in the market or a stronger pullback, we're going to see signs of it in IWM. We're going to see IWM break the 20-pair moving average. We're going to see it come back down to 111 and possibly even all the way back down to the low hundreds, around 103, 101, even all the way down to this level around 100 basically, where we found support in March. And so if you're really worried about the market right now and you want to figure out what's going to happen if we drop, well, this will be the first one to really drop. And once this loses support, then I think it shows that maybe we're not in a sideways market. If we continue to trade sideways, then IWM might just come down and test 111 and kind of support. It'll lose the 20, but it won't drop all the way back down into the low hundreds. If it starts to move down to the low hundreds, I would expect the other indices not to necessarily make their way to lows, but to lose some of those shorter term support levels we pointed out. So that's kind of really the key right now with IWM. I think generally speaking, right now the Qs are the ones leading, and the rest of the indices are following. So that's probably the most important one to follow. But if you want a quicker hint or faster reaction to what's going on to the downside, then you can look at IWM because it will be the first to sell off. But generally speaking, right now I'm looking at the S&P 500 and the Nasdaq as the two that give me a more accurate gauge as to what the markets are doing. All right, so that's the four major markets. If anyone has any question about what's going on with the markets, feel free to ask, and we can have any kind of discussion you want on it. Let's move on real quick to the U.S. dollar. See how it's behaving. As you can see, the U.S. dollar has stabilized a bit. Very, very volatile throughout March and February, and it's kind of skewed a lot of the chart. Nothing like what we're about to see on oil, but basically, at the moment, the U.S. dollar is finally starting to contract in volatility and starting to find a decent range to trade in. Now, we can see that more clearly if we look at the individual U.S. dollar currency crosses. So, what we're going to do first is look at the euro cross. This one is inverse because it's priced in euros. So, up is good for the euro, down is good for the U.S. dollar. And you can see, again, price was contracting, or the range was contracting, and we're starting to get a breakdown here on the euro. Showing U.S. dollar strength creeping up. Now, this is pretty critical. The euro has really struggled against the U.S. dollar for a while now, and this is the beginning of possibly another breakdown. And if this continues, if we make it a little bit lower, then chances are the euro is going to head down below this 107, 108 area and make its way down towards its recent lows. So this is a critical area. It's something important to watch to see if that continues. Again, more than anything, showing U.S. dollar gaining some strength. If we look at the U.S. versus the yen, we'll see the U.S. dollar trying to stabilize here again. The most important thing is that the range is contracting, that we're starting to see some of this volatility start to dissipate a bit and get into a little bit more quieter, more definable ranges. And we're kind of struggling here. So kind of the inverse of the euro, where the U.S. dollar is actually kind of struggling a bit, but it is holding support and trying to bounce. And the big key here is whether it can hold 107.05 or whatever it is around here and hold. Now, and then the last cross we have is the U.S. Canadian. And this one, the U.S. dollar has actually done very well. A lot of this, of course, due to oil weakness, but some of it just due to Canadian dollar doing poorly. But you can see in this one, the U.S. dollar is actually doing very strongly. Actually just broke a nice little breakout through this channel here, showing some nice strength. And so of the three crosses, the one that's doing the best. Again, not a big surprise because of what oil's done. And I think generally speaking, as we can see, we have a picture of the U.S. dollar regaining some of the strength that maybe it lost recently and trying to make its way upwards. But more than anything, I think we're seeing volatility contract, which I think is a good thing. I think that things were getting a little out of control in March, and we'll get more definable ranges across the board as we start to see things calm down a bit. Now, on the opposite end of that spectrum, we have oil, which, as you can see, at this point my chart's basically broken. The ridiculous move that we had on Tuesday, where oil went to trade negative, really shows a lot of the issues that I think are underneath the surface with this market. And surprisingly, the market didn't really correct stronger off of this, but for those of you that maybe are unaware, oil had a move on Tuesday, or actually Monday, where it was the end of a futures contract or one of the rollover periods, and nobody wanted to hold that contract. Nobody wanted to take delivery because there's really nowhere to store oil anymore. And so basically nobody wanted to take delivery. Everyone wanted to go ahead and roll over the contracts, and nobody wanted to buy. And that led to basically one of these black swan events where oil ended up trading negative 30-something dollars a barrel, basically saying that people were willing to pay you to take oil off their hands. Now, once the contract rolled over and we got the new contract, oil went back to 20. But as you can see, well, you can't really see because, again, this chart is ridiculously blown up here. But let's go to 15 minutes maybe, so we could just look at yesterday's price. All right, so here we go. As you can see, we went from $20 all the way down to $10, and then eventually stabilize in the 10 to 13, showing again there is a lot of there's a lot of supply here in oil, and the demand just is not willing to meet up with it, and we're really struggling with oil prices. Um, we can look at USO for a little bit more of an accurate gauge as to what's going on, but basically a lot of people that are going long oil are trying to buy stuff like USO, and they're putting themselves in actually a lot of danger right now, because this situation we have with these oil futures at the moment is very tricky, and until we actually have more demand coming in, we could have another scenario where, again, at the end of this next rollover period, no one wants to buy it again, and we've actually had other ETFs like oil, which are basically going to close on Friday, because they couldn't maintain the rollovers, and basically just had to close their fund. And USO, on the opposite end, have been able to survive for now because a lot of their contracts were June contracts, not April contracts or May contracts. And so what they're going to do now is they're going to reverse split to try to get a little bit higher of a price and to get more, get they're changing basically the way that they structure their ETF in order to try to survive this. And generally speaking, it's just, again, it shows just how drastic the slowdown in our economy has become, where oil is basically just worthless at the moment. Now, it's not going to continue forever, and at some point oil will go up in price. However, I do want to point out at the moment, normally over the last decade, I've recommended USO as a pretty decent instrument for trading oil. It's not the best because, again, for those of you that maybe are unaware exactly how these ETFs work, they have to buy underlying futures of oil, and they have to roll it over every time that we have a change in the futures contract. Unfortunately, that adds costs, and there is a slight decay in USO because of something called contango. It's not as bad as the double and triple leverage funds, and for the most part, USO kind of reflects the price of oil. However, in a situation that we have right now, which is basically unprecedented, all of a sudden this ETF becomes very dangerous because there's the very real possibility that it just closes down and it just shuts down if it cannot sustain these rollovers over into the next quarter or next couple months. So at this point, I would say if you wanted to try to buy the bounce on oil, maybe don't trade USO unless you're willing to lose money. But again, keep in mind, if oil goes to negative, you can end up being on the hook for more than just what you were losing. And that's part of the reason the reverse splitting is to get people to, when someone buys something at $2, they can say, well, I'm willing to lose all of it. But they might not say that if they buy a stock at $10. Even though theoretically they're putting in the same percentage of money, psychologically they're looking at it a little bit differently. And so we're going to have that reverse split, I think, in another week. And we'll see where this goes and how it behaves. But generally speaking, I think at the moment, and I think this goes back to something we said earlier, I'm avoiding oil right now. I don't want to trade oil. I don't want to trade oil names because this is action that is, to me, unpredictable. And like I said before, we're not in an easy trading environment. We don't need to push it. If you don't like a trade, you shouldn't take it. And so for the moment, I'm kind of avoiding it. But if some people like to speculate, if you're looking for a bottom in oil, some of the areas that are doing really good right now are, oil tankers, right? So these are the guys that are getting paid to take oil at $30 a barrel. These are the guys that are holding it and will have an excess of oil once prices do go up to sell. Now, some of that is already baked into the price. You can see a lot of them have rallied and are already doing decently. And so I'm not saying go ahead and buy them now, but maybe this is something you want to put on your watch list and see how they behave over the next couple of weeks. And as you can see, as far as oil names are concerned, I mean, these are all shippers, but they're all doing decently, and they're all holding up well. And maybe that's an area you want to look at, do some more investigation into. Maybe you just want to look at the oil refiners, the gas stations. They're not going to, they're not doing quite as poorly. Like I said, I personally am not looking to gamble on oil, but if you have an interest in this, if you're someone that likes to speculate and feels like there's an opportunity here, take a look at names like that and see if maybe it benefits you. That's really what what I want to say about oil. If anyone has any other questions, feel free to add. But as far as I know, oil's we're basically in unprecedented waters here, or uncharted waters, and really anything can happen here over the course of the next couple of weeks. We could have a big explosion to the upside if we open up business and people start anticipating a lot more energy consumption, or we could continue to kind of have oil prices strangle and just spiral down to zero again if we stay shut down for another month. And so at this point, the the uh, the wide range of outcomes is really something that is keeping me from wanting to trade it. I feel like there are more defined trades available that I'd rather take advantage of rather than try to speculate on what's going to happen with oil in the near future. All right, now we'll take a quick look at gold and silver. Gold actually doing pretty well. You can see it broke out strongly, came back, retested this 158, and actually moved forward. And is starting to make its way upwards again. Again, I think maybe a safe haven right now. Silver not quite as well. Doing definitely more poorly. And if you're into the precious metals, probably you want to stick to gold or to GLD. I personally am also not trading this. I don't have a good comfort level with the chart right now. I don't think it's necessarily anything wrong with the chart. I just don't have a comfort level for something that's this volatile and this wide. And I wasn't really into buying some of these moves that it's had. Again, I feel right now my focus on the long side is mostly tech names because I feel like that's the area that I find has been pretty easy to predict and has done it kind of like the safest as far as what downside is available at the moment for it. All right, so that covers gold, oil, silver, U.S. dollar, and all that good stuff. If anyone in here, again, I see Ray, good afternoon. We'll take a look at DHT in a second. If anyone else has a chart request, feel free to put it in there. I'd love to see what you guys are looking at. All right, Ray, so give me an idea. So this is another shipper. So you were just mentioning, well, actually, I mentioned DHT. Okay, so this is one of the shipping companies. So the one issue I have with it right now, again, like I said, I'm not that excited about trading oil. But the one issue I have with these shippers is, smarter people were in on this ahead of time, and they've already gotten that move from 5 to 850, right? So, this is probably something I should have thought about last week, but I didn't, and I missed it, and they're all the way up to resistance. So at the moment, these shippers they've reached the point where I think that the smart money has already taken advantage of this trade, and now, we want to wait for an opportunity to get back in, or we want to see some kind of continuation pattern before we move forward with any of these sorts of names. So to go back to earnings while I wait for chart requests. Sure, Bob, we'll look at AMD. Actually, we'll look at AMD first then. Alright, so AMD is doing all right. So here we go. So the first thing I look at earnings season, first thing I want to look at 6 days to earnings report, right? So that to me, right there, that says I probably shouldn't try to take a trade on this, or I won't take a trade on this because you only have a week for it to work in your favor unless you're willing to hold through earnings. Now, generally speaking, thoughts on AMD. I mean, they're a processor. Obviously, part of their profits are going to be based off of computers being sold. I don't know how much people are really buying at this moment, like how much money they have to spend. But as you can see, the market and AMD in general has been the market has been bullish on AMD. We're basically near all-time highs, right? We go back and take a look at a weekly chart. You see where we stand, and generally speaking, AMD has been a chart that has weathered this storm very well, right? So I think this falls under that little balloon of stocks that I like to think of that are doing well in this time and are fairly well insulated versus what's happening in our economy. Now, that being said, is there a trade here? I don't think so. Not at the moment. So we had this big move down, right? And now we've had the big move up. It's basically been a V-bottom all the way back up, right? Now, we have resistance, right, at all-time highs. And that's probably going to be something that's we're going to struggle to break through, right? And so I think at this point what we have is we have a stock, and again, you can see it's a nice channel. right? We're not going to keep all these trend lines. It's already getting pretty messy here. But you had a stock that was in a very nice channel. It kind of came down in a very orderly channel. Then it turned around and it came right back up in that same orderly channel. It's probably going to stay stuck in a range until earnings, at which point it's going to break one way or the other, either to new highs or it's going to come right back down and test some of these lower areas. I think generally speaking, as you can see, AMD has been a very strong stock, and this warrants consideration on pullbacks. So if after earnings next week it holds up and it pulls back to maybe 48 or pulls back to 45 or 44, then we can look at it as a possible buy the dip play and expect it to trade within this range. Now, if it breaks out above 59, then I might be a little bit more nervous about buying it. Not because I don't think it can continue higher, but because, like I said, I'm nervous about buying long in the market that we have right now, because I just don't think the risk reward is there to continue going long after we've had such a strong move to the upside, right? So if you look at AMD, it's gone from 38 all the way up to about 58, right? So it's gone up, $20, basically 60 something percent over the course of, or really closer to 50%, I guess, from March to now. And so at this point, if you try to go long, you have to realize that this stock has already had such a big move to the upside, and we what are we trying to catch here? The tail end of it, or do we think that we're going to have a new trend into new all-time highs and continue sustaining upwards? And it could happen. But I think, generally speaking, if I'm playing the odds right now, I suspect that we need to pull back first before we can continue pushing through new highs. So that's kind of my take on this. It's a little bit like the shippers in that we've already seen a strong move, and ideally you were positioned to take advantage of this move earlier. And if you did, then you should realize that this area around 58 is a good area to take profits and wait to see what happens in earnings. So that's basically my thought. And I think AMD again is a nice macrocosm of exactly what we're seeing across the board in the markets, which is, the move already happened. And at this point, we're at the top of that range, and we're trying to figure out what we should do next. Should we continue to press forward and try to push the longs, or do we wait for a retrace and go ahead and take advantage of that? And so in my mind right now, the market is divided into two pretty distinct categories. One is names that have actually been able to hold up during this sort of environment, and the other is names that are being punished severely by being closed down. And generally speaking, the names that have been able to weather the storm and that are able to continue commerce through the internet are performing and outperforming the market. And then other names, like American Airlines or Boeing, are the opposite end of that spectrum, and they're being punished severely for not being able to open. And these are the names that I want to short. Now, again, the problem with these is that some of them don't even give you opportunities to short unless you're playing momentum down, because they don't even come up to resistance levels. But and you see they have earnings again tomorrow, so that's a name that I will be looking at and hoping that they do gap up in order to fade that move. But generally speaking, I think the market is divided into two pretty distinct categories. That's been my theory for the last month. And has been basically the way I've been trading and the way I've been recommending trading. For again, anyone that visits me on patreon.com/StockDarts, you'll know that we for the beginning of March, we were looking at potential long names like Zoom or Citrix or Netflix, and then we're looking for potential short names like this or the cruise lines. And see how they're, and again, you can see they're really struggling. Now, not every name has done poorly. Some retail names are holding up better than others. The hotels haven't really broken down as much as I expected. But generally speaking, these are the names that I think are being punished more severely. And as you can see, even the ones that are doing okay, they're not doing great. They're not really making their way upwards towards their higher moving averages, or they're not like AMD near all-time highs. And so I think that the market is basically divided into two categories right now, and you want to be able to take advantage of it. Now, I know that sounds obvious, especially in hindsight, but I mean, sometimes the obvious trade is the trade you want to be taking. You don't need to necessarily recreate the wheel and come up with some innovative new trade that no one is watching. take advantage of what's working right now. And like I said, what's working right now, stuff like anything related to working from home. Look at Akamai. DocuSign is another one that just keeps doing well. Um, these are the kind of names you want to focus on. A few Wednesdays ago, we looked at some REITs that are involved in cell towers, and look at what American Tower is doing. Look at EQIX, which is based off data centers, and look what they're doing. There are names that are still benefiting from this, and it's not necessarily just Zoom and Citrix. You just have to look for them, and like I said, I kind of did a lot of that work for you guys, and we came up with, at least over the last month, at least 30 or 40 names that are worth trading to the long side and that are worth trading to the short side. And I think that's really where you want to focus right now, is understand that division of stocks that are being punished and stocks that are being rewarded with our current environment, and just try to focus on that. And AMD again falls into one of the stocks that's being rewarded to a certain extent. But like I said, right now risk reward it's not that great, and I'd like to see what happens through earnings, and then we can go from there. I think another one we can look at, of course, is Microsoft. Just kind of in a similar boat. You had the V bottom and the move back up, and not necessarily all the way to all-time highs, but trying their best. And as you can see, by the way, a lot of earnings coming up next week. So next week is going to be a critical time as far as understanding and gauging just what kind of an impact we've had in the markets with being shut down for a quarter here, and see what kind of guidance they have, moving forward into the summer. All right, anyone else have another chart they want to look at? The area, by the way, speaking of names that are struggling, movie theaters, obviously, right? They're not going to be doing well. Now, interestingly enough, what I was pointing out earlier, right? So, some restaurants have been able to actually do better than expected. So, Chipotle is one of them. You can see with their earnings today, they've actually made their way right back up. They're near highs as well. You take a look at what's happened here, and that's a pretty impressive bottom. Now, again, some of this is a little surprising to me, because I doubt that they're, just because they're delivering or offering pickup, that they're going to be doing the same business that they were before when everybody was coming into the restaurant. But as you can see, the market is happy with what Chipotle's done, and they've made their way right back up towards pretty impressive and lofty heights. And again, so I think that this is one of the things that's key, is watching how these names perform during the earnings, and just really getting a better gauge as to how they've been able to withstand this shutdown, and more importantly, their guidance and what they expect in the next quarter. And so far, Chipotle's done pretty well. Another name that did really well was Snapchat. Yesterday's earnings. You can see very strong move now. This is another tech name, and basically people at home have to use something on their phones, and so it's understandable that these guys would do okay. But they had a very, very nice earnings, and again, the market right now is happy with what they're doing. And to go back to Netflix again, I think part of the problem with Netflix is I don't think they had bad earnings. It's just that the market was anticipating good earnings to begin with, and I think that again. So for those of you that maybe think, because I've been saying you got to avoid earnings if you're not comfortable with it or you understand what's going on. You might have a name that you think deserves to have a good earnings, and they might have a good earnings report and still go down. And I think that's part of the issue with trading during earnings season, and why I often recommend for traders to avoid an earnings report, because you could have blowout earnings, but it could already be baked into the price. And I think that's what happened with Netflix when it rallied sharply into the report. Went from 370 all the way to 450 because they were anticipating big numbers, right? And so once you got the big numbers, it was more of a sell than use type of event. And I think that's why usually for earnings, I'll recommend that you avoid it unless you're doing one of two things. One, if it's a long-term hold. If you're holding something for years, then you can't just sit there and try to avoid every earnings quarter. And the other thing is if you're doing like myself, which is trading the earnings event. And for those of you that maybe are unaware of how this works, when I trade earnings, I don't actually trade direction. More often than not, I will trade volatility. I'll look at options prices. I'll see whether they're over or underpriced, and I'll go ahead and then take my bet on that. And so in this particular case, Netflix, the options were pricing a move of over 12%, which I think was overly inflated because we have a high VIX right now and we have a very volatile market. And that led to what I thought was a pretty good volatility selling trade, which I took with a calendar spread. And right now that trade is up very nicely. It's up about 25 or 30%. And I think will likely go much higher as we keep going into the end of the week. I have until Friday, and the closer that thing is to 440, the better off I am. And I think more likely than not, Netflix is likely to kind of rally up at least into the 430s. And if it doesn't, then I'll just close it out and take my 25-30% or whatever it's at right now and be happy. But that's really the way I like to approach earnings, because again, it's very difficult to guess direction because you don't really know what the market's going to do and how it's going to react to it. And again, this is a name that had blowout earnings, record amount of new subscribers, which was expected. And because it was expected, it was still to sell the news despite how good the numbers were. Because again, the move really, if you think about it, probably started here at 370. And so, it is up from where people started buying in anticipation of that news. And just happened that after the report, it kind of came back to this price because people already expected that, right? And so that's one of the issues with earnings that I think people forget sometimes, is that even if a name is if you think it's gonna have a good report, it's a name you like, it may not have a good report, and that's part of the volatility and part of the risk that's associated with earnings season, and why I recommend that you be careful when you're trading. And if you don't use TradingView, whatever platform you use, make sure you take a look at when there's an earnings report, because the last thing you want to do is be unaware of extra volatility that could come into play on a trade, and you end up down 10% on just a regular run-of-the-mill earnings move because you didn't really anticipate it. Okay? So I guess that covers it for today. I don't see any more chart requests. If any of you has a chart request that you didn't want to add in public and you just want to, you can always just ask me on Twitter. You just message me and I'll DM it to you, or you can email me, stockdarts@gmail. I'll be more than happy to help you out there and give you whatever, answer to any question you have, or if you have a chart that you want me to send you, and we can go ahead and do it that way. Other than that, I hope you guys have a good rest of this week, and we'll meet again next Wednesday.